Hello, swing traders. Welcome to the Stock Planner channel, an education channel where we share our ideas, we learn how to swing trade, and we win for life. Today, I'm going to show you 3 stocks that I think you can trade with options and basically use a small account. And these same 3 stocks, the hedge funds are loading up on. They include, no, not Tesla, no, not Nvidia, no, not Google, no, not Amazon, no, not Microsoft. We're going to take a long option play on Procter & Gamble, United Health, which had a big drop lately, and Cisco, which was flying along with these guys. And I think these stocks, Google, Amazon, Microsoft, Apple, Nvidia, all been so hyped up these last 4 or 5 weeks. Some people call it a bubble, but I think we're due for a small pullback. Yes, overall, I think Cisco is a great company. You'll see. Its snowflake is big and green. Great company. But I have a feeling that technically it's ready for a pullback. You can agree or disagree, and I hope you do, and leave a comment below. It helps out my channel. Also, liking and subscribing. It helps my channel. Let's get started. United Health Group, ticker symbol UNH. We see that for the early part of the year, it's been in a downtrend, popped up and has come down. And typically, you would think it would be bouncing and going up. And they're just looking at the charts, but that's not what happened. It dropped like a rock. They deal in healthcare plans. It's a large corporation, very profitable, optional, shortable, and it has a buy rating. A target price of $586. $586 is up there in the moon. There hasn't been any recent upgrades. Motley Fool says 2 beaten down growth stocks to buy in the dip. And when it's dipping, this is a snowflake and it's big and green. That's what you want to see. It paid the dividend. It's undervalued. Great past history. Healthy company. And the future could be a little brighter, but it's undervalued, as I said, by 34%. Earnings expected to grow by 10%. Last year they grew by 18%. And also a good agreement that stock will rise by 25%. This stock should go up, and that's the direction we want to be in. Yamana is a competitor, not green, and as near as I can tell, this drop was because there's fear that dividend will be cut. This is a zigzag, and you can see that this stock trades and swings very nicely. That's what we're looking for, the tops and bottoms. The zigzag indicator tells you perfectly where those tops and bottoms are. Right now it doesn't know what it's doing. It thinks it might go up. Now the zigzag is not an indicator. I use it so I can go ahead and see what other indicators work. This is the RSI, and when it goes above the 70 or below the 30, maybe a reversal is taking place. Stochastic above the 80 and come back around, maybe a reversal is taking place. And when the MACD is above the 0 line, that's the time to look for a reversal. The MACD is close to the 0 line, and I like them to be like this. Anyway, we have the RSI below the 30 come back around. The stochastics may come back around, and so we might see a reversal here at the MACD. This is a questionable, but typically, when you have a gap like this, that gap gets filled. Using some option data, I'm predicting that the expected move is going to be about 6% in the next 60 days. And if I know the percentage of expected move, I can set my targets and my stop losses. Target price of 486. Let's move that down somewhere there. And a stop loss of 437, somewhere there. So looking at this chart, you think this stock is going down there? It looks like Friday it was heading down that way. Or is it going to come back up to where it was trading? This is a good, solid company. So typically, if you have a situation like that, it does mean reverse and revert back to the mean somewhere in this area. So if we know this information, stop loss and target bracket, and we think it's going to go up, what option strategy can we use? Well, we can use a bull put spread, but before we do, I think I want to, we'll look at that. Bull put spread, and then we'll look at a broken wing. Going in the option strat, we look at a bull put spread as a credit spread situation. United Health, that's the price it's trading at now, 458. Right now, we would need to do this trade on their recommendation about $5,000. Let's see if we can do a little better. I think it's going up to 470, and I put one above and one below, and let's just go a little below because I want to do $1,000. So I want to put $1,000 margin. The max loss on this trade is 487, and the net credit is $500. That's sweet. So 1 for 1, basically. The max loss is 487. Just remember that one. And the expiration is August 18th. Setting the range at 6%. That's what we said it was going to move. If it does move, there's our win line there. And our stop loss was at 437. 437. Here's 436. Is somewhere in between here. Let's go to right about there. 294. And our profit is 295. That's a 1 for 1 on this. So as long as the price it stays above $464, there's your win. But drop below that, you can lose some money very fast. You need to get out of that trade. You don't want to lose too much, but you got to let it run as well. This is the playing field. This is your win and your loss. And if you let it to expiration, this is what you'll get. Now let's look at a broken wing. It's the same $1,000, this plus this. This time you only get is 290 credit. But you can see that one of the things I like about this is you can take a profit pretty quickly. Same range, 6%. This is the win line here. And our profit will be somewhere around 266. Same stop loss as we used before, 437. 437 is right in between here, and we go take somewhere around 272, 285, somewhere around that, in between there. Here's the nice thing about a broken wing butterfly. If it ends up, the price ends up somewhere in between here, you can win so much more. You can win up to $1,200 or $1,300, where the max profit over on the other side was just $500. And if it gets away from you and it heads for the hills, you're going to get your net credit up 290. So this is like a Christmas tree. If you actually end up at expiration at the Christmas tree, and also this is your most profitable point, that's where you can hit some gold. So I choose the bull put spread. I think it's going to return and revert to the mean back to 285, 286. And I'm hoping it doesn't go down to 437 to 438. There's many other ways you can buy the stock, although this is very expensive. And trade directionally, you can buy calls, but it just has to move. If you do buy a call, it has to move very quickly, whereby it just has to be above 457 to win in all these areas. It's a win area for the put broken wing, and has to be above 464 for a win. Break even is 464 on the bull put spread, and it's a little lower for the put broken wing. It gives you more. Bullish United Health. Let me know in the comments what you think. The next stock I'm looking to buy is Procter & Gamble. As you can see, it's kind of in an uptrend or an uptrend. Everybody knows what Procter & Gamble makes, household and personal products. It's a USA company. Consumer, profitable based on the PE, optional, shortable, and slightly bullish. A target price of 164, 165. 165 is up in the moon, up in here. And that's a 1-year projection. The last upgrade or downgrade was a downgrade by Truist. And again, Zach says that Procter & Gamble is an attractive pick now. And it says that the article that it has a very strong company with unique pricing potential for their products and a unique demand. It's been happening for a while, and it'll look like to continue. All know the brand. It's trading at 2.4% below its estimate of fair value, so it's slightly undervalued. Earnings are forecast to grow by only 6 or 7%. But it does pay a dividend, and this is a really healthy company. And you can see the chart, this swings very nicely. Steady growth in all its segments, but nothing fantastic. Looking at the TradingView chart for ticker symbol PG on the daily time frame, each one of these bars is a day's worth of data. The zigzag pointed to an uptrend and then a downtrend, and now it doesn't know what it's doing. Our MACD had a crossover, and it's below the zero line, so that's, we look for a long on that. The stochastics says a long, and the RSO at this point said a long. And that would have put that very nicely as a long. When the three indicators line up, that's what I call the three indicator strategy. I think in my mind it gives me a stronger signal. I think the expected move for this stock is going to be about 4.5% over the next 59 days, of approximately 2 months. And if that's correct, and the direction is correct, my target price will be 156, somewhere up there. That's a pretty good haul. And a stop loss will be 144, placing a horizontal line, 144. So it just stopped going up, and we hope it doesn't get below this line. And let's look at our option strategy, called the broken wing butterfly again, and see if we can't get something for about $500. Selling 2 puts and buying 2 puts. We set up a long situation, and the broken wing butterfly gives you an extra bonus if it expires in this area here, $598. Else, it's going to be about $96. We said our expected move is 4.5, and that puts the win line somewhere along there. And I expect to make about 168. Our stop loss was 144.49, 149.50. Oh, excuse me, 144.50, somewhere in between there. And I made my expected loss 159, somewhere in this area here. I expect to lose $159 if it goes down in the red, and win about 168. Now I could let the trade run all the way to the end, and these are my win amounts. But I win as long as this stock stays above 149. I win something. I win as long as it stays above 149. So it needs to be above where it's at now to win. Is this stock going up or is it going down? Is it going to hit this line first or hit this line first? This is your stop loss, and this is your profit target. And the stock needs to be above where it is today. It needs to go up. And if it does go up, you win something. Anywhere. I think Procter & Gamble will have a slow grind up. What do you think? And the last stock I want to trade is a short play based on technical analysis, not fundamental analysis. Fundamental analysis is showing that the snowflake is big and green. This is a great stock. It pays a dividend. It's offering a good value. It's trading below, about 29-30% below its estimate of fair value. This is a good value stock. Earnings are expected to grow 7% a year. It pays a reliable 3% dividend, and it's a good value comparing to peers and to the industry. Why would I want to short a stock like that? Well, this is why. Over the last 2-3 weeks or 4 weeks, this stock has been really on a tear, just like Google, Amazon, Tesla, Nvidia. All of them have been on a tear. I've traded Cisco a lot, and this has always been a good swinging stock. But every month or so, you get a nice steady swing. And I've had a lot of success with the MACD, the stochastics, and the RSI. And the opposite is true, even though this MACD was set to go down and it went up. We're seeing that the zigzag still knows what it's doing, but we had a red bar. So if it get another red bar, you're going to see that zigzag not knowing what it's doing. Stochastic says we're overbought, RSI says we're overbought, and the MACD is well above the zero line. nothing has come back around. So this still could go up. There's no indicators that are saying it can go down, but it's hitting its support, previous support, and I just feel technically this stock, along with Tesla, Nvidia, and a few of the others, will have a pullback. It may be small, but we've been so hyped up with those stocks and AI that I think we need a breather. So can I put a trade together that doesn't cost me a lot to find this out? Maybe $200 or $300 to find this out. The expected move for this stock is about 5% over the next 2 months. Now, the problem with the expected move, using options to predict it, you don't know if it's going to go up 5% or down 5%. My indicators say, hey, we think we might go down soon. And based on that 5% and the current price, I can calculate my target price and stop loss. I want to go short. In this case, I'm going to use a bear call spread. Very easy to trade. Bear call spreads consist of selling a call and buying a call for protection. In this case, I only need to have $250 for margin. That's cool. And I'll make $100. That's about 30%. Max loss, I could lose some money, 157, and the break even is below 53.43 right there. There's my 5% range. Here's my win line if it does get that 5% move. And I could strive for somewhere around $77. Our stop loss was 54.02. 54 is right there. And we're talking about about $55. Long as this stock stays below 53.43, I've got a winner. And doesn't matter how far it goes down below. That's one of the bad things about this. Your max return is going to stay at 93. It's not like the other two that we did with a broken wing, where you could have a variety of outcomes. But this is simple to trade, and it can be cheap. So we're setting our stop loss at 54.02. Let's move up to 54. Place a stop loss and a profit target of 49.47, somewhere around there. And our break even was somewhere around $53. 53. I don't know about you, but I like the looks of that. So we did 3 trades. It's 3 trades that the hedge funds are buying, and one was Procter & Gamble, United Health, and we're going to do like the hedge funds do, is buy it. And we went against the hedge fund for Cisco. But I'll tell you, overall, I'm very positive about Cisco and the Internet of Things and the future of AI. This is going to play a very big role. But it just, the last 3-4 weeks, everything's been AI, gone crazy. Some people call it a bubble. Let me know what you think of these trades. Make a comment below, like and subscribe. Like what you're doing. Do your own due diligence. We'll catch you on the flip.